Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for 𝗏𝗶𝗃. Today is Monday. It's September 20th, and we're going to be opening up in about 2 hours. And boy, oh boy, what have I been telling you the last few weeks? Markets are vulnerable. Momentum levels are declining. The put-to-call ratio is a little overdone. There's a big choppiness coming up. The markets are fragmented. You remember all of that. And I told you that we really need to have a shakeout before we can go higher. And I think this may be the first part of it. Now, don't get stressed out. Don't go jumping off the buildings. I don't think it's anything crazy. I think this is a much needed shakeout. The markets are down anything but random. As you could see, 538 points on the Dow, 170 on the Nasdaq, 57 on the Dow. And if you look at the bond market, it is not all that much higher. It's only up by 0.77. So I think this is going to be a reversion, and I don't think this is going to be meaningful, and I don't think this is going to go anywhere. Because I'll tell you why. I'll show you why. Let me show you my charts real quick. This is my 11 sectors. And if you look at it right now, remember I told you we need a nice little healthy pullback to get stop being fragmented and to get back into a consolidated market? Well, look at tech and consumer discretionary. They're finally next to each other. So and look at industrial and basic materials. Utilities is off of consumer staples, but just by one, financial. And you got healthcare here. The bottom line is, I think this is the second shoe dropping. I don't think this is the beginning of something. I think this is more of an end to something. Now, the markets are down, but if you look at momentum levels, which we've been looking at every single day, and I told you markets are down in the dumpster, we're already below the 49th percentile. See, here's the thing. If we were in the 80th percentile or 70th percentile, and this is looking at any stock trading above $2, then if that was the case, I would be very worried, but we've already come down quite a bit. It's just that the large caps were not showing that same level of downside compared to the large caps. And I demonstrated that last week when I showed you the Nasdaq 100 versus the Nasdaq Composite, where here you have 55% of stocks trading above the 50-day moving average. But when you look at the Nasdaq Composite, you only have 47. And the 200-day, you only have 53. So we're literally at the 200-day moving average. So I think that what's happening right now is just a representation of the larger cap stocks coming down as well and kind of consolidating. So I don't think this is the beginning of something. If it is, it's too early in the year. Not too early in the year, too early in the season. Usually this type of volatility occurs going into way into October. September's too early. The VIX is only up 4 points, about 21%. We're at 21. We're not 25. We're not at 40. So I believe the market's going to cool off and undo much of what it did with the bond market coming down again and us getting through this. If you look at the equal balance SPY, we're right now at the 50-day moving average. We should actually technically be somewhere in the twilight zone further down. And if you look at the Dow Jones, you will see a very similar pattern. We've been going down for several days. We may bottom out around the 340 or the 330 level. We may even hit the 200-day moving average. But I don't think this is a major event. I think this is just a global hiccup in terms of volatility, which is very much needed because we haven't had much volatility. Put-to-call ratio is still random. We're nowhere near 0.60, 0.70. We may end up being there tonight. But the bottom line is I wouldn't worry too much about this as of right now. This is very much needed. Now, let's talk about what's causing all of this. Usually when the market's down 400, 500, 600 points, it's global events. Nothing impacts U.S. stocks more than global events. So investors are watching to see, and by the way, I should have probably started here. I'm going to go back and forth. So the moral of the story is, or the punchline is, Fed announcement. The economy is getting stressed out, worried about China and the Fed. That's the overriding concern. And the big stories this week from the Fed, not the big stories, the big reports is going to be housing, existing housing starts, housing market, new home sales. Jobless claims I'm not really concerned about because retail sales was on the level and the numbers have been really solid. What we're really concerned about is what the Fed is going to tell us, all right, what Jerome Powell is going to tell us. The Fed press conference. Are they going to take action? Are they not going to take action? I think they're going to take action. We're going to see the opposite effect because we need to do something about this bond market. They're putting $120 billion into bonds, and retail sales data is positive. Meanwhile, international markets are going a little haywire. So I think they're kind of in between the rock and a hard place. With COVID getting better, they can blame China, but it's going to be rough. So this is what's on the agenda. Wednesday's a big day. Friday's a big day. Those are the big days of the week. We got to watch the housing market because that's going to impact. We got 1, 2, 3, 4 housing reports this week. So housing market and interest rates. Now let's talk about global economy. Sorry, I'm kind of going all over the place, but I kind of need you to see what's going on and what's really driving this market. Investors are watching to see whether the Fed will take any action to address the impact of rising prices on businesses and consumers, inflationary pressure. And here's the thing. If anything, if they're going to take action, it would be to unwind, not to wind up higher. They're not going to start putting more money into the market. They're going to put less money into the market. So I don't really see the impact of why the bond market is up so much. I mean, there's a floor here. There's a ceiling here. And I mean, we know they're going to take action. If they already told us, if not this year, beginning of next year. So if they take action and stop buying $120 billion worth of bonds every month, do you think the bond market will stay up? No, which is why I'm short the bond market right now. All right. Sorry, I'm getting all worked up. Worries are mounting also about the U.S. debt ceiling. House Democrats said Friday they plan to move this week to suspend the cap on the government's borrowing authority. Wow. And the White House ratcheted up pressure on Republicans by warning state and local governments that severe cuts lie ahead if the measure fails in Senate. That's big, 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 big. Heavyweight Hong Kong property companies and bank lost ground on persistent concerns over the potential for ripple effect from the financial troubles from the Evergrande company. The company was expected to miss interest payments as rising company's forecast says it may default on its debt. Henderson Land Development dropped 13%. New World Development lost 12% as a result of all of this. And China would tighten oversight over property sector in Hong Kong. Yeah, they should have done that about 5 years ago. The Fed, here's the big one for the week. The Fed is due to deliver its latest economic and interest rate policy on Wednesday. Central banks has said high costs of raw material and consumer goods are still likely to be temporary. Hey, there's no time to lower the amount of buying than now, if you guys mean it, as the economy recovers. But analysts worried that higher prices could stick around and dent companies' bottom line while also crippling spending. And that's really, really what's causing the market. China and interest rates. So again, we're going to start off the week a little slow. I think we're going to peak out to the bottom side right around Tuesday or Wednesday before the announcement. Honestly, I think if anything, the Fed is going to take action to lower rates, and I think the market is trying to sucker us in right now. But honestly, I just don't see this downside going beyond the 200-day moving average. But as I told you guys, this is really, really needed right now because this gives these sectors that have been fragmented. Look at it a month ago. Look where technology is and look where consumer discretionary is. And look at it today. So this is actually pretty healthy. And the fact that technology is behind real estate and real estate's number one, we're going to keep our eye out on the real estate sector. Matter of fact, if you're looking at the chart, it looks like it's going a little lower, but I think we're going to bottom out on the XLRE. That's the real estate sector, right around the 45 level, and I think we're going to start coming back higher. So keep your eye for a shakeout, a big, big shakeout. Now, in light of this, I've got some stocks that have been pulling back, and I think today is going to be a great buying opportunity for them. Near the opening, maybe a little bit down. Here's what I suggest you do. Don't start, if you're going to buy 100 shares, start buying 20. Buy 20 now, buy 20 tomorrow. Over the next 3 days, buy 100 shares. So don't put all your eggs in one basket, but I think the volatility on Nextera, NEE, a little too much too fast. So I think this is a great buy for this morning, all right? I've been talking about Garmin. Notice all of these stocks near the 50-day moving average. They're still above the 50-day moving average. Garmin, we talked about this last week. I told you guys I like it above the 50-day moving average. With the market opening really down today, it may be a buying opportunity. Next one, Cube. Remember the REITs, self-storage REITs? I love this stock. Hitting the 50-day line, almost at the 50-day line. I think this morning we're going to hit the 50-day line. I love this stock. And last but not least, Facebook. Facebook is now trading below the 50-day moving average. I think it's a hiccup. Look at this stock. Every time it pulls back down, it goes back up, and it's been doing it for quite some time. And I think we're going to shake out and pull back up. I think this is the last stage of the non-fragmentation in the market before the market really shakes out and gives us the upside we need in October, because I'm expecting a lot of volatility in October. So keep your eye on the S&P 500. We're going to be opening up about 1.38% lower as of right now. We still have about an hour and 50 minutes. But again, don't make too much out of this. Let me show you something. As of Friday, all right, I want to show you this. You only had 68 stocks breaking down and 87 stocks breaking up. So markets are very, very choppy, and there's not a lot of liquidity. So it's not hard to cause this type of this kind of ripple effect, especially in the overnight markets, because markets are not ready for it right now. All that October liquidity hasn't come back. So don't make too much out of what's happening right now. Don't do that. Look at this as illiquidity volatility. The market breadth is very narrow. Put the call ratio is still within its zone. It's not even showing us that the market is scared right now as of yet. I'm sure it will, but not as of yet. The bottom line is, take this pullback with a grain of salt, because I think this is just the beginning of some volatility, and I think ultimately this could be a really good buy opportunity. That's why I like Nextera, Garmin, Cube, and Facebook. Now, I've got something really important for you, something you got to pay close attention to. Most people might not realize this, but when traders enter the stock market to place their moves for the day, they're already at a huge, huge disadvantage. That's right. The fat cat, like the big banks, hedge funds, huge institutional investors, they don't go to sleep. Come on, think about it. Too much money's on the line. Their overnight action and pre-market activity often dictates where the market is headed when the market opens in the opening bell, which is why I do my analysis 2 hours before the opening bell to show you what the market is going to do after it opens. See, pre-open market, notice I'm doing this 2 hours before the market opens, but I'm gauging what the market is going to do after it opens. You see a pattern here? Now, their overnight action and pre-market activity often dictates what the institutions do overnight, often dictates where the market is heading before the opening bell, which is why we're doing this before the market opens. And that's why the world's number one. That's why the world's number one pre-market trader has developed a system that analyzes off-hours activity, very similar to what I'm doing right now, and gives us a chance to piggyback off of those huge money moves. It's very, very similar to what I'm doing, but it's a lot more specific. And it's like a roadmap to finding stocks that have gone up every time. I love this thing. Folks, are you ready to find out what could amount to a huge market move before the market opens so you could take advantage of it after the market opens? Of course you are. Are you ready to get started? I'm sure you are. Click the link below to get all the details. The world's number one pre-market trader has got to show you what he's got in store. This is some really good stuff. Check it out now. This is the time to get an unfair advantage when volatility is running amok like right now. Take advantage of these markets, folks. And make sure to like this video. If you're watching on YouTube, why not subscribe to that channel by hitting the bell? Folks, be one step ahead of the market by being the first to be notified when I post my next video giving you all of these goodies before the market opens. You'd be crazy not to want these. And have a great day. Bye, everyone. And don't get too spooked out. This is just the second shoe dropping right now. This is not a start to something. This is the end of something. Bye.